Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to introduce a new feature to Vox Markets, that is investing in large cap overseas stocks. Indeed, given the events of the last week with the sort of schizophrenia across the markets, it's important that all portfolios have a bit of ballast and liquidity so we can all sleep safely at night. And what we're hoping to do over the next few months is build up a sort of like a virtual model portfolio of international sort of best in breed companies that we can monitor and track, and hopefully as a portfolio that will deliver sort of like double-digit returns over the sort of the medium to long term with less risk. So should we kick off? I'm going to introduce two stocks hopefully will fit the bill today in the healthcare sector that I actually do own. Anyway, I'm just going to share the screen so we can get the slides up. Yeah, so there we are. Vox Markets, large cap global investing. Just a slide for the FCA. This is obviously not financial advice, and they're just really sort of my views. No, and obviously past performance is no indicator of future returns. But anyway, we've gone through the formalities. Right then, so what's the purpose and the aim of building up this sort of portfolio? Well, it's really to sort of like to have a portfolio of around about sort of 20-25 best in breed international stocks, all with sort of like a market cap of more than £1 billion. And it's not going to be a tracker fund. We're going to generate some alpha, and we're going to really try to be quite selective to give us what we actually want, sort of secular growth trends driving these particular companies, and to obviously there was another objective is to be able to sleep at night, given the volatility, particularly in the sort of small cap space, which is my sort of like area that I normally do. And we're going to try and aim to generate sort of gross returns of sort of 10% per annum over the medium to long term, with lower than market typically beta to generate a sort of like a Sharpe ratio of more than one. But I would point out that it's not an environment at the moment to try and be a hero and to try and knock the ball out the park. And we're going to try and go for sort of like singles and doubles. And as I keep saying again, patience means profits, and we're going to be diversified across certain sectors. We'll give updates hopefully every fortnight, and this is obviously free for everybody, so hopefully it will save people some fund charges and fees. Okay, so what type of stocks are we looking for? Well, as I say, best-in-class operators, leaders in their field, sort of like industry champions, operating in secular growth areas, expanding industries where there's sort of like, greater demand than there is supply, large addressable markets, and lots of IPR in the actual companies to give them pricing power, the wide, economic moat, the sort of classic Warren Buffett type of stocks, lots of differentiation, operating leverage, the high profit margin. So if they increase £1 at the top line, it will drop disproportionately to the bottom line. Robust balance sheets. You can't have a stock or a company that has to need to go to the market in the next few months, because it just really is shut up shop. Profitable, cash generative, capable management team at an attractive valuation. So no pressure there. Pretty tough ask. So where are we today? Well, as I say, we've just had three banks, two, which have gone bust. SVB, Silicon Valley Bank, Signature, out in the States. We've always had Credit Suisse going bust. It hadn't been saved for the Swiss National Bank, and First Republic has been bailed out by a number of US institutions. But I do think these are just temporary circuit breakers, and there's going to be more issues which are going to come out the woodwork as we go forward. So definitely expect some rocky times. I mean, what's happening basically is the traders in the market are really sort of in seek and destroy mode for the weakest links. Any bank that has got sort of like deposits that can transfer from its balance sheet quite quickly, or has got a lot of unrealized losses there from sort of its bond portfolio or even its real estate portfolio, then it's getting targeted. On the other side of the coin, so we actually have, that's going to be a sort of like, a lot of demand destruction. On the other side of the coin, we still have sticky inflation, and consumers are struggling on the cost of living crisis and changing behaviours. So the central banks are really caught between a rock and a hard place here. And I actually think, say, if you look at the ECB yesterday increasing interest rates by 0.5%, then I think the rule of thumb for the central banks is going to keep it in restrictive territory to make sure inflation comes down, and use other policies to help the oil the wheels of the banking system. So definitely, well, my view now is that I think we're going to go into a recession in the second half, and that's absolutely borne out by the less inversion of the 2 to 10-year yield curve out in the States, and that's shown there is such that you've had this, if it's inverted, it sort of indicates there's going to be a recession. But when you actually do see short-term rates, which then start to decrease faster than the longer term rates, that says that the market, the bond investors believe the Federal Reserve and other central banks are going to start reducing their interest rates. Maybe still stay in restrictive territory for the actual conditions, but they're going to start reducing, which then sort of like is the first sort of sniff of the trigger of we're going to get a recession probably in the next sort of like 6 months' time. What that means for sort of like corporate earnings is probably not great. As you've seen over the last year, we've had the S&P 500, those estimates actually decreasing consistently. And I've got a sneaky suspicion if we have a recession in the second half of 2023, there's a good chance the estimate for next year of $248 per share is actually going to come down. I could see us being flat year on year from sort of like 222 to 220. In 2024, no growth at all. And if you put a sort of 16 times multiple on that, you get an S&P of around about 3,500 compared to 4,000 currently, which is a sort of like a haircut of 10 to 15%. So I think we've just got to be prepared to batten down the hatches and, as I say, go into large cap international companies that have been around for literally decades. Then that's going to give us that level of solidity in the actual portfolio. So we'll be able to, as I say, hopefully all sleep at night. Preferred sectors are those ones as I mentioned with secular growth, and there's two ones I'm going to do today which are defensive and have secular growth and a good value, is in the biopharma and the medical diagnostics areas, but also going forward we're looking at decarbonisation, electrification. Nuclear is an excellent area. Climate change, cost and labour saving technology, clearly that's going to be a winner going forward as companies need to reduce their cost base. Robotics, automation, there's not much value here at the moment, so we're going to have to be a bit patient. Aerospace, actually, surprisingly, it's got pretty full order books, particularly from places like China and India that have had sort of like difficulties or sort of struggling with COVID, and now actually really do need to upgrade their fleet to become more fuel efficient. That's going to be improving the supply chain for all of that. And obviously you've got the defense side with all the aerospace there as well. Cybersecurity is well known, trodden ground. Generative AI, well known, and quantum computing, very, very pricey. So yes, if we see opportunities there, then we'll be able to take it. Probably the picks and shovels players rather than the direct operators. But if we do see value, then that'll be an area. But it's definitely got long-term growth. Defense is solid. It's going to carry on, unless obviously the risk is that there's a ceasefire in Ukraine and Russia, and that sort of reduces. But I still think the threat posed by places like China is going to mean that the biggest purchase or procurement of defence budgets, the US, is going to carry on. So that's going to drive a lot of value. And there's lots of really world-class defence companies out in the States. B2B software, business-to-business software, digitization, fintech and payments. That's getting more competitive, particularly in the consumer side, nearshoring, and then sort of the counter-cyclical plays, because, as I say, I think we're going to have a recession probably in the next 6 months, and it could well last, a good year. So those are the kind of secular growth areas we'll be looking at. What type of annual long-term returns? Well, typically for large caps, you get sort of 9%, but we're going to hopefully shoot for something better. I tend to try and go for the small caps most of the time, but I want some more. I want a bigger exposure myself of large caps. So this will be useful for me if it's not even useful for anybody else. And my historical returns, just to give you a bit of background. I've been sort of like investing since I started work, which was the early 90s, but I've been sort of like doing it professionally since March 2020, so just over 23 years. And in that period, my portfolio has actually gone up by about 15% per annum compared to the FTSE All share of about sort of 1%, which is absolutely terrible. I would say, though, because I've sort of specialized in small caps, my hit rate is only 2 in every 3. So a third of my stock picks don't actually generate money. I'm hoping, obviously, with larger caps, there'll be still, but that hit rate will be better, but the returns are not likely to be 15%. And there you can see on a sort of chart with the recessions, you can see the volatility, how it sort of like moves up and down. And so that doesn't help me, as I say, doesn't help my nervous system or my sleep patterns, which are pretty poor anyway. I am hoping to have that much smoother for the large cap international portfolio, but it won't be as steep. So remember, elephants typically don't gallop, but I'm not looking, as I say, to knock the ball out of the park. I'm hoping for some sort of good singles and doubles that you can just keep adding to the actual portfolio and generate good alpha. My current portfolio at the moment is very heavily on the small cap side and on cash. I have about 30% cash. I've got plenty to deploy in the large cap sector. I've only, if I put them in large caps together, there's only 8%. And those are the two which I'm going to go through today, Pfizer and Roche, both mega companies, roughly around about the same size, actually, sort of $250 billion in market cap. So not insignificant, but offering real good value in my view anyway. So just coming on now, sort of the golden era of healthcare. Why am I interested in this particular sector? Well, as I say, you've got the typical demographics, aging populations, growing, sort of like size of the actual populations in emerging markets, and they want to actually increase their, the quality of their healthcare as well. We're entering that's really demonstrated from the pandemic, entering it's sort of like a period, an era of innovation with revolutionary new technologies such as gene editing, mRNA, immunotherapies, AI, genomic sequencing, personalized medicine, and breakthrough diagnostics. So really fertile hunting ground here for stock ideas. Also, you've got healthcare, countries and organisations want to reduce their costs, and obviously they've got this huge backlog, not just in the UK but elsewhere around the world of hospital waiting lists for elective procedures. So that's going to be extra demand on top. The big advantage, obviously, with healthcare during these volatile times, schizophrenic times, is that they offer sort of safe harbours amid stormy seas. And Pfizer and Roche actually have been pretty stable, even though the banks have been going up by sort of like been yo-yoing over the last few days. Obviously got plenty of IPR and pricing power, which is great. And one interesting thing is if you go sort of large cap biopharma at the moment, I think because of the sort of like the difficulties of the cost of capital of the banking system, many of their smaller rivals are going to struggle to get funding, get access to it. Therefore, I think the competitive position for large, big pharma is actually going to be enhanced over the next few years. So first thing then with Pfizer, it's roughly trading just over $40 a share, which is about where I bought slightly higher. Market cap is 225 billion. That's supposed to be, not million. Sorry about that. And it's really been unfairly sold off. You probably know it from obviously its COVID vaccine and its antiviral Paxlovid. It made huge amounts of sales last year. There you go, sort of like nearly $57 billion. But that's going to reduce significantly this year, and that's what's reasonably spooked investors. It's going to reduce to around 10 to 13, and that's going to be sort of trough sales, and hopefully then it will increase going forward. However, I think it's great value at sort of like $40. It trades on around about sort of 9 times EBITDA, just over 12 times PE, and which is falling to less than 11 times in 2024. It pays a sort of like a 3.5% dividend yield, and I do actually think even if you stripped out COVID, I think the base business, which is growing at sort of 6% like for like per annum, and is growing its earnings around about 16%. I do think the base business on its own can generate EPS around about $2.50, which if you put on a 16 times multiple, because it's growing pretty well, would generate sort of $40 per share of value in my sort of like calculations anyway, which means you get the COVID vaccine and the franchise for free, and that's sort of like can be used. They've got this relationship with BioNTech for mRNA sort of COVID vaccines, as you know, and they're using that technology in their own vaccine business as well to do things like shingles and all kinds of different things. So there's plenty of scope for growth there. It's got a very, very rock solid balance sheet, only 10 billion of debt, and that gets extinguished this year anyway. I mean, they generate a huge amount of cash. As I say, they've got about 4% dividend and over an 8% free cash flow yield as well. gives them all masses of plenty of firepower to buy, and they've put a bid in for oncology expert Seagen for 43 billion pounds, which will take a bit of time to get through the regulators. It may only close the back end of this year. But this really does add a bit of expertise in antibody drug conjugates, which is the next level of sort of like next generation cancer treatments targeted to actual, sort of like cancerous cells without the effects of sort of chemotherapy. And it adds to its own portfolio of 24 cancer drugs. It's got a really strong pipeline. It hopes that Seagen is going to increase its sales to around about sort of $10 billion by the end of this decade, from just over two for this particular year. So masses of growth. And there was a nice quote from the CEO when he sort of like put this bid in. We say we're not buying golden eggs, we're actually acquiring the goose that lays the golden eggs, because this is a platform of unique patented technology that they'll be able to use in numerous different indications. And it isn't just their own drugs, it's in combinations with other therapies as well. So as I say, they've got a strong pipeline. They've also got potentially a blockbuster migraine, so acute migraine treatment coming out, which has got approved. And that will go live, I think, in the next year or so. But they've got strength in autoimmune and other sort of like, disease areas. And this should then replace the patent cliff they have from 2025 onwards. And there's, you can see the actual stock. Before the pandemic, it was trading roughly around about sort of like $35, and it's at about 40 now, and it went up to around about nearly $60. So it's come down a long way. I've bought these, just interestingly, because it's a US stock, in my AJ Bell SIP to avoid the 15% withholding tax on dividends. So that's the most tax efficient way of doing it. There's no stamp duty, obviously, when you buy overseas shares from most countries like the US. So that's great. You save 0.5%, but obviously you do pay 4x on the dividends, and you pay it on the transaction going in and the transaction coming out. But for all intents and purposes, that's sort of like 0.5% in and less than 0.5% in and 0.5% out. And if you hold them for sort of 5 or 6 years, then it just wipes its nose anyway with the almost like with the stamp duty. But I think it's a great valuation with a strong pipeline. And this is sort of like this is where the market's got spooked. It had a blockbuster results last year, obviously on the back of their COVID vaccine, the antiviral, and they delivered over $6.50 of EPS, and that's falling. That's almost sort of halving this year. But that was a trough, and it's going to go to, I think it's about 380 for next year. And there you see the long-term growth of the base business, excluding the COVID products, going from roughly around about, I think it's 44 it did last year, going to like 52 by 2025, and then up to between 70 and 84 by the end of the decade, which is good, strong growth. And you've got to remember, these are, sort of pills. So, gross margins here is 80-85%, and even 90% in a lot of instances. So, plenty of potential profit drivers. There is the patent cliff. This is where you lose exclusivity on actual drugs. So you can see that's coming out. This is their potential non-COVID revenues from the actual pipeline itself. This is sort of like BD deals. This is the sort of like including the likes of Seagen into that. And this is also potential new revenues from their own internal sort of pipeline to give them all of those revenues. So really strong pipeline. I'm very encouraged. So, cheap valuation seems like a pretty much a done and dusted deal. Roche actually is a pretty similar size business. There's obviously a different mix, but it's a sort of like a 210 billion Swiss franc. So it's around about sort of similar sort of size as Pfizer. Very, very high quality. It again has been hit badly by sentiment in terms of its reducing COVID sales, which is not a surprise. It was very successful in its diagnostics business and also with its COVID antibody cocktails that it sold to a lot of hospitals. It also had a bit of its sentiment was impacted last year by a failure of a late stage Alzheimer's drug. But as I say, it does have a really strong pipeline of next generation oncology, biospecific and multiple sclerosis, haemophilia and antibody drug conjugate drugs as well. So certainly lots of IPR there. Also, it bought a Genentech some time ago, about 10 years ago, and it's getting a slight drag from that. With previously, Genentech's patented drugs in cancer, Avastin, Herceptin, and Rituxan. They're actually losing patent, and therefore that's going a bit. But most of that's already happened. But the shares at current levels trade on, say, 9 times, just over 9.5 times EBITDA, 13 times PER, 14 times PER, pay a 3.5% dividend yield, and they offer a sort of 7.5% cash flow yield as well. So real good, strong cash generator and on attractive valuation. I would sort of value it at around about 15 times 2024 earnings to give you around about just over 310 Swiss francs with a 10% with a sort of 3.5% dividend yield. So it's again good value, absolutely sort of like, rock solid balance sheet, very little net debt, and it's a nice mix actually from both pharma and diagnostics, because diagnostics is nearly 28% of revenues last year, and that's really grown because companion diagnostics, these are diagnostics that go with drugs for personalized medicine, is really flying, and they're big into that area. So that's one of the like it. And then the diagnostics business again and the pharma should benefit from the return of elective procedures. And there you see the shares have come down considerably from their all-time high of around about sort of $400. And I think they offer really good value. I've bought the non-voting shares, which are the most liquid. I don't really need to vote. It's a massive business, and they trade on the Swiss stock exchange. There is actually an ADR out in the US, but I just went direct straight to the Swiss. There's no stamp duty again, but I am actually going to be suffering 15% withholding tax on the dividends, and we'll have the forex cost. But I think the value here is so good that I can suffer that one. Last year, the underlying business was actually growing by sort of 3 or 4%. I think that will accelerate going forward. And there you can actually see the mix across the relevant sectors with the growth in the diagnostics here and the reduction. That was in 2017. That was the contribution from the Genentech portfolio. It's now reduced there, so significantly less, but they are expecting revenues to slightly decline this year, and that's why it's going to be sort of trough earnings, and then they're going to accelerate thereafter by about sort of 15-20%. So plenty to look forward to over the rest of the decade. For both, obviously, for Pfizer and for Roche, there are some biopharma risks that people need to be aware of, patent challenges. I've highlighted those, and expiries, pricing pressure in the US because the authorities, particularly Medicare, are trying to actually reduce their cost base, competition, and the usual standard things with the risks associated with drug development and pipeline failures, regulatory action and fines and adverse, the usual sort of stuff. But basically, both of these companies are absolutely stuffed full of fantastic IPR and world-leading healthcare technology. So I'm delighted to own them and add them to our virtual portfolio as the first 2 defensive stocks with good long-term secular growth. So anyway, that's the end of this, the first episode. I hope you enjoyed it, and obviously we'll connect again hopefully in a couple of weeks' time, and I'll highlight some more potential stocks. Thanks very much.